In the CenterPoint budgeting feature, we offer multiple budget entry modes. Each one of those entry modes affects the budgeted financial statements a little bit different. This video is going to explain those different modes. For this video, I am in our CenterPoint for Agriculture product. However, this particular video does go ahead and cover the same topics for all of our CenterPoint programs. So it includes information for the CenterPoint business product and for the CenterPoint fund product. Now, typically to start a new budget, you would either go to Reporting Tools and Budgets, or you could go to Setup and Budgets. Either place is going to take you to the same screen. To start a new budget, we click the New button at the bottom of the screen. Now, the video on creating a new budget talks about setting up these different parameters here on this first page, but what we're specifically talking about in this video is the information that is set on the Entry Mode tab over here. On the Entry Mode tab, there is a selection for different entry modes. And there are 4 different entry modes: Use Account Entry Mode, Journal Entry Offset to Cash, Open Entry, and Detailed Transaction Entry. This video will take you through each one of those modes and how they affect the different budgeted financial statements. We're going to begin with Journal Entry Offset to Cash. So I'm going to get out of here and we're going to go ahead and bring up a cash budget that we've already started. So I've already set up the parameters for this cash budget here. We're going to see what those parameters are by going to File and going to Properties so that we can bring up that budget properties screen that comes up when you first create a budget. So you can see here that I'm budgeting for CenterPoint Farm and that I'm doing an 1-year budget from January 1 of 2021 to 12/31 of 2021 with beginning balances of December 20th for the balance sheet. On the Entry Mode tab, we have selected the entry mode of Journal Entry Offset to Cash. So I'm going to show you how Journal Entry Offset to Cash affects your different financial statements. When you're entering in budget information, you're always going to enter in the budget information on the Flow of Funds tab. So we're going to begin on the Flow of Funds tab. So down here at the bottom, you can see that I'm on the Flow of Funds tab. And down the left-hand side, we have all of our different accounts. We start out with our our income statement accounts. So I have revenue. And then if I collapse up the revenue, I would have the expenses, and then I would have all of my cost of goods accounts, expenses, other revenue, other expenses, and so on. So I'm going to scroll down here to some of my expense accounts, and I'm going to go ahead and enter in a simple expense account here. And I'm going to come down here and find one of my utility expenses. So I'm just going to do something simple on a utility expense. So let's say, for example, that I wanted to go ahead and budget for a $150 electricity bill for the month of February here. So I'm in the column for the month of February, and I go ahead and I plug in the $150. Well, I'm using the Journal Entry Offset to Cash mode. So when I'm using that mode, every entry that I make is going to be automatically offset to cash. Now, since this Flow of Funds tab contains all of my accounts on it, I can scroll down further on the list here, and I'll come down to my cash accounts over here when I get down to assets. And you can see here that that $150 that we entered in on the expense line created a $150 decrease on the bank account line. So this is on the Flow of Funds tab. How is that going to affect our balance sheet? Well, the balance sheet account that's really affected by this is really our cash. So we should see a decrease between January and February of our cash balance. So if I come over here to the balance sheet tab, it's going to go ahead and take a second and go over to the balance sheet tab. And if you look here between the months of January and February, you can see the $150 decrease in that account just by that one entry. So that's what an offset to cash is going to do. Likewise, on the income statement, that since that was an expense, it was a income statement account. If I scroll down here on the income statement down to the expenses, and I come down to utility expense here, that's utility costs, but not utility expense. So we'll come down a little bit further. You'll see the $150 flow through to the income statement portion of this. So that's going to create an increase in expenses on the income statement portion. Okay, the same is true if I were to enter in an amount to a balance sheet account. So let's say if I came over here and I went ahead and anticipated an increase in one of my balance sheet accounts. I'm going to go ahead and find one that I want to use. So I'm going to scroll down just a little bit further. Well, actually, let's go ahead and say that we wanted to anticipate an increase in one of our liabilities here. So I'm going to go ahead and come down to the liability section. And let's say that I wanted to anticipate an increase, that we're going to take out a line of credit loan for $35,000 in March. So I want to enter that in as an increase. Okay, notice that the $35,000 increase in liability also caused a $35,000 increase in assets. So it was automatically offset. If I come back up higher onto the list of assets here, I'm going to come up here to where I see my cash account. It also caused a $35,000 increase in my assets. And that's going to be reflected on the balance sheet again. So if I come over here to the balance sheet, you'll see if I come down to my liabilities, I'm going to collapse up my assets there, and I'm going to come over here to my liabilities and come down to the line of credit, and you can see here that it went from being 0 in February to a $35,000 increase in March, but it also went ahead and it is going to increase my bank account too. So you can see here on the same balance sheet on the cash line here for First National Bank between February and March, we've seen an increase of $35,000 for that loan that we took out and deposited into the bank account. It was automatically offset to cash. So it went ahead and did that. Now, when you're using your automatic offset to cash or journal entry offset to cash, it's going to always create a balanced transaction. So you're always going to have a balanced budgeted balance sheet. And since this one did not affect any revenue or expense accounts or cost of goods accounts, it does not flow through to the income statement. So the only activity at this point on the income statement is still the $150 to the utilities expense that we entered in before. Okay, so that is basically how journal entry offset to cash works. It's usually used for people who want to enter in both a budgeted balance sheet and a budgeted income statement, or at least want to see what the result of all of the information that they put into their budgeted income statement has on their cash balances if they're trying to manage cash flow. So they can at least go ahead and see what it does to their cash level, even if you aren't going to budget for any other activity to any other balance sheet account. So now we're going to switch over to a different budget, which is set up as just an open entry budget. You can see at the top of the screen, I've called this one Open Entry Budget 2021. And if I go to File and I go to Properties, and I come over here to the Entry Mode tab, you can see that I have taken and I have set the entry mode at the top of the screen to open entry. Because of that, I didn't have to select a bank account to offset to because it's not going to create an offset. So here I am back on the Flow of Funds tab, and I'm going to go ahead and enter in the same $150 utility expense. So I'm going to come back down to my utility expenses over here underneath expenses. I just need to find it really quick. Okay, here's utilities expenses. And I'm going to go ahead and enter in the $150 in February like I did previously when I was showing you the journal entry offset to cash. Now this $150 here didn't create any kind of an entry. If I come down here to cash, down here at the bottom, it didn't create any kind of offset to cash. So when you're using an open entry, if I go over here to my balance sheet, now remember on journal entry offset to cash, it that $150 created a decrease in my cash between February and March. And you can see here that it had no effect on my cash whatsoever. Okay, if I go over to my income statement though, I'm going to go over to the income statement at the bottom, and I scroll down to the utilities expense on my income statement, you'll see that it did flow through to the income statement. So I do have a $150 expense that's appearing on the income statement. Okay, so that's how open entry works. Now, if I use open entry on a balance sheet account too, I can come over here to that same liability account. So remember in our last session or our last our last session on journal entry offset to cash, we went ahead and put $35,000 increase in a line of credit account down here in line of credit. Okay, now before that $35,000 had created an increase in my total assets of $35,000, which had been an increase in my bank account for $35,000. But you can see here that the open entry mode doesn't do that. It doesn't create that offset. So if I go over to the balance sheet now, we'll let it go over the balance sheet here. You'll see that between February and March, there is no increase in my cash for that $35,000 that was taken out on that liability. And if I come down here to my liabilities, and let me scroll down just a little bit further. If I come down here to my liabilities, you see that it does put in a $35,000 increase in the liability, but because that wasn't a balanced budget transaction, there was no offset, I now have a balance sheet that's not going to be in balance. So generally, if you're using the open entry mode, either you have to make sure that you put in your own offsetting entries, or you need to you might use this mode if you are not worried about monitoring your cash levels, or at least or not interested in a budgeted balance sheet. So primarily it's for those people who are only really interested in having a budgeted income statement. So that leaves us with a couple other entry modes. One of those entry modes is called the account entry mode, and the other entry mode is called detailed transaction entry. You can see here at the top of the budget that I have gone ahead and now opened up a budget called Use Account Entry Mode. And I can see that by going to File and to properties to bring up the budget properties. So I've had the same budget properties settings over here that I did for the journal entry offset to cash and for the open entry. But this time I've got my entry mode set as account entry mode. Now I'm going to actually explain the detailed transaction entry mode as well while I'm in the account entry mode. Okay, when you're in account entry mode, for the most part, most of your accounts are going to default to journal entry offset to cash. Okay, so if I was to go down to that same utilities line, so I'm going to go ahead and scroll down to the same utilities line. And we'll come down here to utilities expense. So I'm going to go ahead, just like I did on the other budgets, I'm going to enter in that same $150 on February. Okay, so you'll see here that $150, if I scroll down to the balance sheet accounts and come down to cash, did create that $150 decrease in cash. Okay, that did flow through to my balance sheet and has acted just like journal entry offset to cash did. So when you're in account entry mode, most accounts are going to just default to journal entry offset to cash. However, what it's actually doing when you're in account entry mode is it has automatically set all of your accounts to use their default template. Okay, so for most accounts, that's great. Now, I'm going to go and switch up a little bit here, and instead of talking about the balance sheet account right now, I'm going to talk about a revenue account here. And in this particular company, now keep in mind I'm actually in an agriculture company. They have an inventory of corn. So when they sell their corn, they want to be able to decrease the inventory on that account. So they could do that one of two ways. They could put in the sale as one entry and let that offset to cash, and then they could take and put in a decrease to their inventory and let that offset to cash, and then go ahead and put in a decrease to their offset account for their inventory, and that would create the other offset to cash, which would then leave them with the total effect of what happened to cash. Okay, that's a lot of entry. Normally, when they're in data entry, it is going to go ahead and decrease their inventory. So by default, if I were to just go over here on the sales of corn line and put in a $30,000 sale of corn, it is going to pop up because I normally in data entry use a template to sell the inventory. It's going to pop up a screen asking me for the inventory account that I'm selling out of. And then it might ask me for the location of where that is. Now, this is definitely in a agriculture database. So I'm going to go ahead and try and do another example for that is non-agriculture. But I've gone ahead and selected that I wanted to sell 20 corn that is in my home silo or in my home bin. So it's going to decrease inventory as well. So when I click OK here, not only does it create an increase or an increase in my revenue, it goes ahead and it offsets that with cash. So if I come down here to my cash line, we're going to see that increase in cash of the 30,000, but we had to take some out of inventory. So there's another journal entry that happens with that sale. So we have a decrease of 29,000. The inventory was valued at 29,832. So it goes ahead and it decreases it by that amount. And then up here, back on my income statement, I have the offset to that decrease. So it's creating a balanced transaction here. So I have the offset to that. Now those activities are going to flow through to my balance sheet. I'm going to go over to my balance sheet here. And you're going to see here that we're going to see an increase of cash for that $50,000 or that $30,000 between February and March. We are going to see a decrease in our inventory. Okay, so here it was in February, and there's the decrease in March. So those pieces flow through to my balance sheet. As well, on my income statement, I am going to see the revenue and then the offset to that revenue for the value that it was already on the balance sheet at. So we're going to see that happen on our income statement. Okay, a similar transaction happens when you sell inventory on the business side, but usually that inventory is purchased. So instead of offsetting an accrual income account, it's actually offsetting your cost of goods account. And so it's a similar transaction on that. So this is what detailed transaction entry mode looks like. Well, I wasn't in detailed transaction entry mode. I was in account entry mode. So for account entry mode, most accounts will be set to journal entry offset to cash, but some accounts would be using detailed transaction entry mode if their default template was set to a template that was more than just a transaction between that account and the bank account. Okay, I can see this if I go to File and Properties. I'm sorry, not File and Properties. If I go to File and Budget Account Properties, you'll see that I'm highlighted on the account called Sales of Corn, which is where I was entering in my transaction. And you can see that that line by itself is set to detailed transaction entry mode. Okay, and this is the template that we use in regular data entry, where something like my sales expense line is set to journal entry offset to cash. Okay, so most accounts are going to be set to journal entry offset to cash, and certain accounts might be set to detailed transaction entry mode if that's the normal entry mode that you use in normal data entry. So when you use account entry mode, you are able to change the entry mode on a line-by-line basis. So even if the default was set to something else, you could highlight that line and then go to File and Budget Account Properties, and you would be able to change the entry mode to use whatever entry mode you wanted to for just that one line, but it wouldn't affect any of the other lines. So that is basically the difference, and that is why account entry mode is the default mode. So if you're planning on using journal entry offset to cash, then it's probably okay to go ahead and use account entry mode. The only time that you're really gonna probably want to change your entry mode is if you're using open entry and you don't want it to offset to anything else. Then you'll probably want to change your entry mode. Otherwise, you could use account entry mode. With account entry mode, it's going to use journal entry offset to cash to most lines, but you can change what mode on a line-by-line basis. And that is how the different entry modes affect budgeting and the financial statements in budgeting.